explain material theory of revenue as an element of financial statement. Revenue is one of the essential elements in financial statement, reflecting the result of a company's primary activity over a certain period. In general, revenue refers to the inflow of cash or other assets generated from business activity, such as the sale of product or provision of service, and service as a key indicator of a company operational success. This element not only function as a benchmark for growth but also provides a basis for investors, management, and external parties to assess the performance and sustainability of the business. The definition of revenue is financial accounting standard is tailored to the characteristic of each entity. According to Financial Accounting Standard or FAS, revenue is defined as the inflow or enhancement of economic benefit during a specific period that result in the increase in equity. Revenue can come from various sources such as the sale of goods and services, interest income, royalty, and dividends. Difference in these sources determine the method of recording and recognizing in financial statement. There are two common methods for recording revenue: the accrual method and the cash method. In the accrual method, revenue is recognized when the transaction occurs, regardless of when payment is received. Conversely, in the cash method, revenue is only recorded when money is actually received. Most companies, as the accrual method, as it is considered to be the reflect the true economic situation and provide more relevant information to financial statement users. Revenue recognition records certain conditions to be met. According to revenue recognition principle is VAS, revenue is recognized when goods have been delivered or services have been rendered. The sales price can be objectively determined, and there is reasonable assurance of payment collection. If all these conditions are met, revenue can be recognized in the financial statement. However, if there is uncertainty regarding payment, revenue recognition may be different until the uncertainty is resolved. Revenue play a strategic role in analyzing company performance. Through the income statement, revenue forms the basis for calculating net income, which in turn is used to measure the operational efficiency of the company. High revenue, if balanced with effective cost control, can lead to strong profitability. Therefore, revenue growth is a primary goal for many companies, which strive to increase sales and expand market reach. Additionally, revenue is a vital element in company valuation. Commonly used valuation methods such as the price to earning ratio and enterprise value to sell heavily rely on revenue. Increased revenue, especially if it is stable and sustainable, as usually boosts the company value in the eye of investors. As it reflects long-term growth potential and competitive strength in the market. However, recognition is not always straightforward, especially in complex transactions. In certain industries, such as construction or software, revenue recognition often needs to be done gradually or based on the progress of work. This approach aims to more accurately reflect the benefit the company receives from completing a project and to avoid premature or delayed revenue recognition. The importance of accurate revenue recognition is also tied to accurate and principle-based financial reporting. If revenue is recognized improperly, it can result in misrepresentation in financial statement, ultimately affecting the decision made by users of this report. For example, premature revenue recognition can provide an overly optimistic view, while the recognition may lower the perception of performance. Revenue should also be classified in detail to provide clear information about revenue results. Large companies typically break down revenue into several categories, such as core product revenue, additional service, and sales or royalty. This segmentation helps report users understand each segment's contribution, which is important in assessing business diversification and risks. In financial analysis, revenue can also be examined through revenue growth and revenue margin. Revenue growth shows how the company develop over time, while the revenue margin assess how much of the revenue is converted into the net income. A higher margin indicates better cost efficiency, which is also a positive indicator of the company performance. Revenue is not the only element to consider in assessing a company's financial health. Other components such as expense, income, and cash flow should also be analyzed comprehensively to get a complete picture. Although higher revenue is a positive sign, it is essential to ensure that revenue growth is accompanied by healthy cash flow and effective cost control. Overall, revenue theory is accounting encompasses not only recognition and recording, but also analysis and interpretation. Revenue provides crucial information for stakeholders to understand business potential and support better decision making. In practice, proper revenue management is key to maintaining transparency and credibility in financial statements and building trust with investors and the public.